Have you ever wondered why the same bag of chips that cost $5 a few years ago now costs 20? Or why your salary goes up, but somehow life still feels more expensive? That mystery is called inflation. But inflation is not just about prices going up. It's a much bigger story, one that affects your savings, your job, and even the entire country. Today, let's break inflation down in simple and fun words. What exactly is inflation? Inflation means that over time, the price of things increases and the value of your money decreases. Think of money like ice. Ice melts slowly. In the same way, the value of your money melts slowly every year. For example, if you keep $50 in your pocket today, maybe next year those same $50 won't buy you the same amount of things. Not because your money disappeared, but because everything around you became more expensive. This slow increase in prices is inflation. Every country in the world has inflation, sometimes low, sometimes very high. The goal is not to stop inflation, but to keep it under control. Why does inflation happen? Inflation happens when there is more demand than supply. Imagine a bakery that makes 100 cupcakes, but suddenly 200 people want cupcakes. What happens? The bakery increases the price. That's inflation. Another reason is when countries print too much money. If everyone has more money, people try buying more things. But the number of things doesn't increase immediately, so prices go up. Sometimes inflation happens because the cost of making things goes up, like fuel prices, electricity, or raw materials. When companies pay more for production, they increase their product prices. These small increases in many places create one big thing: inflation. Types of inflation. There are mainly three types of inflation you should know. Number one, demand pull inflation, when too many people want something but there isn't enough supply. Number two, cost push inflation, when making things becomes more expensive, so companies push prices higher. Number three, built-in inflation, when workers demand higher salaries because everything is expensive, then companies raise prices to pay those salaries. It becomes a cycle. These types often happen together. For example, fuel becomes expensive, transportation becomes expensive, food becomes expensive, workers ask for more salary, prices rise again. Understanding the type helps governments decide how to fix the problem. How inflation affects you? Inflation hits everyone, whether you are rich, poor, a student, or a business owner. First, everyday things like groceries, clothes, and transport become more expensive. Second, your savings lose value. If you keep money under your pillow or in a simple bank account, inflation quietly eats it. Third, inflation affects jobs. Sometimes companies reduce hiring or increase prices to survive. But inflation can also be good in small amounts. A little inflation encourages people to invest, start businesses, and keep the economy moving. Too much inflation, however, can destroy savings, break businesses, and make daily life hard. Good inflation versus bad inflation. Not all inflation is bad. Countries actually want a little inflation, usually around 2 to 4% every year. Good inflation means the economy is moving, people are buying things, businesses are growing, and salaries go up slowly. But bad inflation, also called hyperinflation, is dangerous. This happens when prices rise extremely fast. For example, in some countries, bread prices change daily. People rush to buy things because money loses value every hour. This destroys trust in the economy. Good inflation is like a warm fire that keeps you comfortable. Hyperinflation is like that same fire burning out of control. How governments control inflation? Governments and central banks have powerful tools to control inflation. Number one, increasing interest rates. When loans become expensive, people buy less and businesses slow down. This reduces demand and brings prices down. Number two, reducing money printing. Less money in the market means prices rise slower. Number three, controlling imports and exports. If a country lacks something, prices rise. Importing more goods can bring prices down. Number four, tracking fuel, wheat, sugar, and electricity costs. These things affect almost every product. Governments constantly watch inflation because it can help or harm millions of people depending on how well it's controlled. How you can protect yourself from inflation? While governments fight inflation on a national level, you can protect yourself too. First, avoid keeping too much money in cash. Cash loses value. Instead, save money in things that grow, like fixed deposits, index funds, or assets. Second, learn new skills that help you earn more. When prices rise, your income must rise too. Third, avoid unnecessary debt because loans become harder to pay during inflation. Fourth, track your spending. Small daily savings add up over months. And finally, invest in yourself, your health, your knowledge, and your career, because these things grow faster than inflation. Inflation is everywhere. You can't escape it, but you can understand it. And once you understand it, you can protect your money, your future, and your family. If you enjoyed this simple explanation and want more videos like this, make sure to like, comment, and subscribe. And remember, money grows when you grow. Thanks for watching.